Welcome. Today we are going to look at demand and supply trading strategies as it relates to bank zones with special focus on gold, that is XAU USD. And we are going to look at the following. We are going to look at, what is demand and supply? How does demand and supply correlate with bank zones? How to get demand and supply from bank zones, how to trade demand and supply from bank zone in different sessions, then the actual trading, exits, entry and exits. Those are the things we are going to look at. Okay. To explain what demand and supply is in a layman's language is you can term demand as the support where the markets went to at a particular point in time, and I couldn't get to that very I couldn't get beyond that very particular place zone, and then the market reverses. So you can term this area as a support zone, and it is a demand zone as well. Then we can look at this place, this zone where the market could not get beyond and it begins to reverse. The market moved here, couldn't reverse, couldn't get beyond here, and it came down and it went there again and it came down, went there again and came down. So you can say that here is your resistance zone and here again is your supply zone. So we have support zone is the demand zone, while the resistance zone is the resistance zone is the supply zone. Okay, that is just that in a layman's language. So actually, it is nothing more than that. It is just very simple. You can look at here as your supply zone. You can look at here as your supply zone, this area. You can look at here as your supply zone. You can look at here as your demand zone. If you scroll, you know, you, there are a lot of, in the charts. Here is your demand zone and here is your supply zone. So it is very, very pictorial and you can easily spot them if you actually know what you're looking for. But this is just actually what you should look for, where the prices, market price could not get beyond and it reverses. So either down or up. If it is down, that's your demand zone. If it is up, that is your supply zone. Okay. All right. Let's go to the next one. The next one is how does demand zone correlate with bank zones? Okay. If you look at in a forex section, there are different in a forex market there are different sections that make up the forex market and make it to be a 24-hour trading market because okay, those sessions are we have the London session, we have the US session, we have the Asia session. Those are the three major sessions that we have. Although there is New Zealand session, but that is just really, really minor. But the major sessions we have is the London, US, and Asia. Then, at this session in time, the London is 8 a.m. to 4 p.m. London time. Um, US session is 8 a.m. to 5 p.m. US time, and then the Asians um, session is 8 a.m. to 5 p.m. Asian time. That is Tokyo time. Okay, and most banks are working, and they are trading actively during the different sessions. So, like in London, the banks in London are very, very active during the London session, likewise, US and Asia. So, the thing is that those bank zone, they have areas that they normally, you know, would not get beyond, which correlates with the previous area they have um gotten to before. Okay, if I take this down to um 15 minutes time frame and then zooming in. Okay, I will just give you a very typical example of what happens during the different sessions. You know, the black, this way I set up this chart is black is for Asian session, red is for US session, and blue um is for London session. So the thing is that these banks in these different sessions, they always know where the previous price they moved the market from, and they always repeat, in most cases, always repeat the same thing at those areas. If you look at this area now, like this is a US session. US session opened here, went down here, then pushed up to this place, and then rejected at this zone, and then went down. Then the Asia opened, went down here, push up, then never got beyond, then closed here. London opened, pushed as high as this, went down. But the thing is that US opened, pushed back to that zone, pushed back to that zone. So you can say that this zone, US session zone, this zone, US session zone, and this is US session supply zone. This is US session supply zone. You can look at this Asian session supply zone, because if you look at during Asian session, you can look at what price did. Price moved to this zone, rejected, moved to this zone, rejected, tested it again, and rejects again. So if you look at it, this is within the same session, and then this is another session. The price just within the Asian, Asian session, it never got beyond this session. Okay, then if you look at this, that's you see that the same thing keeps repeating itself every now and again, every now and again. There are several sessions. If you look at here, I'm just giving you a typical example of session. This is London session, whereby they tested they tested the same zone, same supply zone, and you know um it never went beyond that zone. But if you look at these two, you see that this London session too, you know this demand zone, this was the lowest London went to in the London session, then US. Asia. Then another London did, but it never came near this. But the next time, after this one, two, three, after like 2 days, it tested that zone, that supply zone again. So when if I am in a London session, you know, I know the area of the supply zone. I know the supply zone and the demand zones for US session. If I am in London, I know those areas. If I am in Asia, I know those areas. But the thing is that in most cases, London and Asia seems to correlate in most times. But since the instrument we have a special focus is gold, and gold has its best movement in US session. So the most we are especially going to be focusing on US session. So you see a whole lot happen in the US session whereby all these zones are always correlating. If you look at demand zone, you see how many times there is a reaction in that zone, and how many times there is a reaction in that zone, and how the market is always behaving when they get to that very particular zone. So with that said, I just um, we just need to understand that these zones whereby the US high and the US low, there is most likely to be a reaction in another US session. Let's take for instance this session now. This is the US low, this is the US high, and this session went down. Then if you go to another US session, if there is most likely that the markets would still get the same reaction from that same particular zone. So that is the reason why it is if the zones, if you just draw out the zone, you may likely take a good trade off of that zone in another session. Okay. We go to number three. Number three, we look at is, hey, how does band zone correlate with supply zones? Okay. If you look at this, generally, we look at this the supply zone. Generally, for the market, this is the supply zone. And this is, you see, there is a lot of supply zone. This is the demand zone. You know, London touches there. London touched it again, but this is the supply zone, demand zone. Sorry, and it is the support. And if you look at here again, this is supply zone. This zone here is a supply zone for the mental, because price went here, then touches again, came down, broke it and went back down, then came here and touches and went to that same zone. So you look at, in most cases, US session in gold always creates the most significant supply and demand zones. US session always create, because in gold the most movements happen during US session. So they create the most supply and demand zones. You know, that is one thing we should have on board. Because if you look at this, you see that in most cases you see US. Even when you go down, US created this push. US, you see, in every supply, US, this, you know, all those pushes to supply zone and demand zone. Demand and supply zones, they are always, they always happen during US session. So if you know that all this happen in US session, all you need to do is, you know, if the US open, you will just mark out the previous day high and the previous day low, and then depending on the direction of the market, you just take your allow the market to get to either of those zones and then take your trade and ride it. It's as simple as that. You don't really need fanciful charts. You don't really need, you know, indicators to really, because these zones, this trading patterns is based off of price action. When the market gets to that zone, you see how the reaction is going to be going. Then you just begin to look at reversal pattern, W pattern, M pattern, and begin to look at, rejection, candle rejections and all that. And then you take the trades. It's as simple as that. Okay, if we go to how to trade the demand zone from different session, if you are how to trade those bank zones, because what the banks are looking at their own zone, like during Asia, what they are looking at, okay, they push to a particular area, then they go down, then they are most likely to test that area again within their own zone, depending on where the market is. So, so like this is a typical example. Day one, day two, push, push for Asia. Then, if you look at London, day one, day two, push down, and it rejects at those areas. Then in US, since our special focus is mostly on US, so you see that a lot of the this thing is mostly on US. The trades are being taken off of US zones, and this is just like like we have today. This is the high of US. This is the high of US. So this is US high, US low. Okay, what happened is that depending on what the market does, you know, what the market does, we know that the market is actually bearish. The market is actually bearish. So actually, you're looking for sells, not buys. So what I would do here in this instance is that I would have marked out my top US high, US low, and that gave me a supply zone, a demand zone, for this day. Then what I will look for is either we look at another zone where there was a reaction in US session going up, either the market, okay, hold on. There was this reaction here for US. So what I will look for is I'll look for this. If the market will push to this place, and then I'll take a sell, or if the market pushes to anywhere around where I would note a US reaction, a US session reaction within this zone. Within this zone, I will just looking at the reaction and all that, I will take a sell. Then, or if there is a break below this zone, if there is a break, I will just take break and retest. I will just when there is a break, I'll wait for market to come back to this zone and then take it down. So that is basically the two trades I will be looking to trade. The same thing applies. The same thing applies to when the market is bullish. If the market is bullish, I will just let's assume that we are in a bullish market here. I'll just look at you know a bounce of this zone and then take it up. and or a break and retest of this zone and then take it up. So that is basically how um, I take my my trades off of that zone. So okay, then that takes us to entry. How do we take an entry and how do we target what could be our targeted, you know, um, targeted profits? Okay, it is very, very simple. Simple in the sense that depending on what our where our zone is. Okay, let me just say we have this zone here. Coming. Let me just zoom in so that it will be clear. It will be clear. So we have this zone here. Okay, let me take it to a higher time frame. We have this zone here. So I will just take this zone and then draw the line because that was the 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 place. If I go to 1 hour's time frame, that was the closest the US traded at that zone, the closest from where we are now. Okay, I can take here. Okay, this is a zone I'm looking at. I can take this zone as well. This is the zone I will be looking at. Because this is a previous US high, but this is a previous US low. Okay, I will be looking at this zone because it's a high. Okay, those are the two zones I'm most likely to be looking at, within this trade. So if the trade comes in at this zone, depending on the reaction, let me remove this. Let me remove this. We are looking at taking our trade here now. Depending on the reaction in this zone, depending on the reaction when the market comes, react, then depending on the reaction, you know, I would take a trade down, then I'll put my stop loss above this zone, above this zone, above this zone. I'll take my stop loss above this zone. Take the trade here, depending on the reaction, whether if I see there is a push up, then there is a little bit of push down, then a test again, then I'll take the trade. As long as the push up is not beyond this zone, I'll take the trade. Then I would put my stop loss just like five or how many 5-10 pips above the zone. Then where would my target be? My first target will be here, this zone. But the main target I will be looking at is this zone, the low of this previous US. I'll be looking at this zone. That is the zone I'm most likely be looking at. I'll be looking at taking the trade off here and then looking at this zone to take my profit. I can take partial profit at this zone, which is the low of the previous day low, and then my next target will be here. So take the trade off here, target here first, then um, 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 then take profit here. Or if this is a break and retest, let's assume that the market breaks here and then come back to retest this zone. I'll take the trade off this zone, and then my first target will be here. My first target will be this zone. My next target will be this zone. This zone. So that is just basically, it is as simple as that, you know. It's just a matter of us having patience and all that, you know. The trade is simple, and it is visual, and it is based on price action, whereby you don't have to contend with, you know, indicators that lag, and you don't have to, you just need to like know, okay, where are my zones. And once you properly understand where your zones are, and you take your trade off those zones, and then, you know, look to the next zone for you to take profit. Then, you know, there are other things like trade management, in trade management, and then, you know, managing your your portfolio, or how much you are willing to, you know, risk in your trade, in terms of risk management. You know, those are other areas you need to look at, because, you know, the way gold moves in a very fast way, so that you don't lose your money. So those are essential. Those are the things we'll look at in the next video, that I'm going to do. So basically, explaining this is just to show you how simple or how easy to take trades off of these zones. When you know the zones you are looking out for, and when you know the zones you are targeting, trading becomes easy and fun. I hope you really get something out of this trade today. If you have any question, just leave it in the comment section. I would definitely answer whatever question you may have. And if you like this video, kindly subscribe to this channel, like the video, subscribe to the channel, so that when I produce more videos, you will be notified, you know, about, you know, the video we produce next. I thank you for coming this far, watching this video to understand what, you know, we have to explain today in terms of demand and supply trading strategy. Thank you, and God bless.